The tax-free savings account is the single most powerful financial tool available to Canadian seniors, bar none. No tax on growth, no tax on withdrawals, no impact on your GIS, no impact on your OAS. Complete flexibility to put money in and take it out whenever you want. It is a genuinely exceptional account, and yet a significant number of Canadian seniors are using it wrong, not intentionally, not carelessly, but in ways that are quietly costing them money, sometimes thousands of dollars every single year. In this video, I'm going to walk you through the 5 most common TFSA mistakes I see seniors make. Some of them will surprise you. At least one of them is probably affecting you right now, and every single one of them is completely fixable once you know it is happening. My name is Donovan. Let us get into it. Before we dive into the mistakes, let me give you a quick foundation on how the TFSA works, because a lot of the mistakes stem from misunderstanding the basics. The TFSA was introduced in Canada in 2009. Every Canadian resident, 18 and older, accumulates contribution room every year. For 2025, the new room added is $7,000. If you have never contributed or have contributed less than the maximum over the years, your unused room carries forward indefinitely. If you were 18 or older in 2009 and have lived in Canada as a resident since then and have never contributed to a TFSA, you may have over $95,000 of total contribution room available right now. That is a significant amount of tax-sheltered space sitting unused. Inside the TFSA, any investment you hold, savings, GICs, stocks, ETFs, mutual funds, grows completely tax-free. And when you withdraw, you pay zero tax. Zero. And those withdrawals do not show up as income in any government calculation. That last part is critical for seniors, because it means money coming out of a TFSA does not affect your GIS eligibility, does not trigger the OAS clawback, and does not push you into a higher tax bracket. It is invisible income. That is an extraordinary advantage, and it is one that too many Canadians are not fully using. Now, the 5 mistakes. Mistake number 1. Using the TFSA as a plain savings account. This is the most common mistake by far. Someone opens a TFSA at their bank, deposits money, and the bank automatically parks it in a low-interest savings account inside the TFSA. The account earns 1%, maybe 1.5%. The person thinks their TFSA is working for them. It is barely treading water. The TFSA is not a savings account. It is an account type, a wrapper that can hold many kinds of investments. GICs earning 4 or 5%, Canadian dividend ETFs paying regular distributions, broad market index funds growing at the rate of the stock market, bond funds providing stable income. The tax-free advantage of a TFSA is only as powerful as the return on what is inside it. If you are earning 1% inside a TFSA, you are essentially just sheltering 1% from tax. That is not the same as sheltering 5% or 7% from tax. The fix is simple. Log into your financial institution. See what your TFSA is actually invested in. If it says high interest savings account or savings, and the interest rate is below 2%, you are underusing this account significantly. At minimum, consider moving TFSA funds into a GIC, earning a competitive rate currently available at 4% or higher at many institutions. Or work with a discount brokerage like Questrade or Wealthsimple to hold low-cost ETFs inside your TFSA. Mistake number 2, not knowing your contribution room and over-contributing. This mistake costs Canadians real money in penalties. The Canada Revenue Agency charges a 1% per month penalty on any amount you hold in a TFSA above your contribution limit. That is 12% per year on money you already saved after tax, on top of any income tax you already paid. People overcontribute for 2 reasons. First, they do not know their total room. Second, they misunderstand how withdrawals work. Here is the withdrawal rule that trips people up. When you take money out of your TFSA, you get that room back, but not until January 1st of the following year. So if you withdraw $10,000 in March and recontribute $10,000 in September of the same year, you have overcontributed. The room from that withdrawal does not come back until January. Many seniors close an old TFSA at one bank and open a new one at another bank in the same calendar year. They transfer the full amount and assume it is fine. If they withdraw from Bank A and deposit at Bank B as cash, rather than doing a direct transfer, they have used up their recontribution room for the year. The fix: always do a direct institution-to-institution transfer when moving a TFSA. Never withdraw and redeposit in the same year unless you are certain you have unused room to cover it. And check your contribution room at My CRA account before making any large contribution. Mistake number 3, holding the wrong investments inside the TFSA. This is a more advanced mistake, but it matters. The tax-free advantage of a TFSA is most valuable when you hold inside it the investments that would otherwise generate the most taxable income. Canadian dividends, interest income, capital gains, these all have different tax treatments outside a TFSA. Interest income is taxed at your full marginal rate. Capital gains are taxed at 50% of your marginal rate. Canadian dividends get a dividend tax credit. The most tax-efficient investments to hold outside the TFSA are Canadian dividend-paying stocks, because the dividend tax credit already makes them relatively tax-friendly. The least tax-efficient to hold outside the TFSA are interest-bearing investments like GICs and bonds, because interest is fully taxable. So where should GICs and bonds go? Inside the TFSA, where interest income is completely sheltered. And where can dividend stocks often stay? In a non-registered account, where the tax treatment is already relatively favorable. This is called asset location, placing each type of investment in the account where its tax treatment is most efficient. It does not change what you own, it changes where you own it. And over a long retirement, the difference in after-tax income can be meaningful. Mistake number 4, not using the TFSA to protect government benefits. This connects directly to topics we have covered in earlier videos, and I want to make the connection explicit here because it is so often missed. If you are receiving the Guaranteed Income Supplement, every dollar of income you earn from RRIF withdrawals, interest, dividends can reduce your GIS. The reduction rate is 50 cents of GIS for every dollar of other income above a threshold. That is a 50% effective tax on income for GIS recipients. But money coming out of a TFSA does not count, 0. So if you have both a TFSA and a non-registered account, and you need money for a large expense, a home repair, a medical device, a trip, drawing from your TFSA rather than your non-registered account could preserve thousands of dollars of GIS in the same year. Similarly, if you are near the OAS clawback threshold, taking income from a TFSA rather than selling non-registered investments keeps your income number lower and protects your OAS. The TFSA is not just a savings tool, it is a benefit protection tool. And most seniors who are eligible for GIS or close to the OAS threshold are not thinking about their TFSA in those terms. Mistake number 5, not maximizing TFSA room before it is too late. The TFSA is a use it when you can tool. Your contribution room accumulates whether or not you use it. But there is a common misconception that you can always catch up later. Here is the reality. The most valuable years to have money growing inside a TFSA are the years when you have the most time for that growth to compound. And for seniors, those years are right now. Every year of delay is a year of tax-free growth that cannot be recovered. Many seniors have large sums sitting in non-registered investment accounts or even in plain bank accounts, while their TFSA sits partially or completely unused. Moving that money into the TFSA gradually within your contribution limits is one of the most straightforward improvements available to almost every Canadian retiree. If you received an inheritance, sold a property, have an old savings account that you have not touched in years, or have cash sitting in a GIC that matures, that money, moved inside a TFSA, begins growing tax-free immediately. And when you need it later in retirement, it comes out without adding a single dollar to your taxable income. Let me give you a concrete action plan for right now. Step 1. Go to my CRA account at canada.ca and look up your TFSA contribution room. Write down the number. Step 2. Log into your TFSA account and find out what it is invested in. If it is sitting in a low-interest savings account, identify an alternative, a competitive GIC, a low-cost ETF, or a dividend fund, and consider moving it. Step 3. Think about your income picture. Are you receiving GIS? Are you close to the OAS clawback threshold? If so, your TFSA is not just an investment account, it is your most important income management tool. Step 4. Look at your non-registered accounts. Are there interest-bearing investments there that would be better inside the TFSA? Move them within your contribution room. Step 5. If you are planning any large withdrawal in the coming year, take it from the TFSA first if you have the room, not from an RRIF or a non-registered account where it adds to taxable income. The TFSA is the one account in Canada that is genuinely designed to work entirely in your favor. No hidden costs, no benefit clawbacks, no tax at the end, but only if you use it correctly. If this video helped you identify even one thing you were doing differently in your TFSA, please share it with someone who could benefit. And if you have not watched our videos on GIS and OAS clawback yet, both are linked in the description, because the TFSA connects directly to both of those topics. I am Donovan. I will see you in the next video.